Hey gang, this is Greg Barron. Thanks for joining our channel again today. We've got some significant news coming down the pike that we want to share with you. A lot of it has to do with this banking crisis that we continue to hear about. I want to visit with you a little bit about what a classic bank panic is, and then maybe jump into just what are the primary constraints that banks have to deal with in the first place, and what contributes to potentially their failure. We'll talk a little bit about the cycles that we've had over the years, and then finally we'll summarize with some of the opportunities that we think we always might have in this transference and transition of wealth that always comes with the dips and the ebbs and the flow of business. So let's talk about this issue of panic and what contributes to it. Would you believe that there's been 9 major bank panics since the history of the United States? Some are worse than others. A lot of people say this one is really small on the scale of panics, but it's a panic, no doubt. But what's interesting is history tends to repeat itself, and you can take a substantially well-run bank in anywhere in America. You can apply a herd mentality of panic to it, and then all of a sudden, that same well-run bank could be in a deep dive to manage through the chaos and the herd mentality of panic that's presented. This is just a natural course of cycles that we go through. I don't believe we're ever going to change. But it reminds me of an analogy that happened in 1988 in Yellowstone. And in 1988, there was this lightning strike in the middle of the forest, and this strike basically set off this catastrophic fire. It burned 1,200 acres. I used to visit it, so I remember. I saw some of the damage that it did. And during that time, prior to that, the park rangers would suppress these fires so that it wouldn't burn as much because they thought that they were doing the ecosystem of the forest less damage by doing so. But they actually found out that if they would let it burn out, it actually produced a greater amount of growth after the fact. And what they learned is this dying, rotted vegetation would decay and build up as a form of type of fuel. And if it built up and built up and built up, and they had this lightning strike, it became catastrophic and just was an inferno. If they would have just not suppressed it and allowed the natural cycles of these fires to burn, they wouldn't have this all of a sudden explosion at one time. I bring up that analogy to say that cycles in business are natural. And sometimes when I see the suppression of cycles and also the manipulation of cycles by monetary policy and Big Brother stepping in, what we find is that this same type of fuel can build up, and all of a sudden, it can create a greater problem with unintended consequences than it would otherwise have had if they would have allowed these cycles to be less porpoising than this great spike. Now, I'm not saying that some intervention is not required, but I am saying that almost always you see unintended consequences with monetary policy manipulation. Case in point, you've got Silicon Valley Bank. And what do? They step in and they backstop them. And then all of a sudden they send the signal, and Secretary Yellen says, well, but we're not going to guarantee the deposits of the smaller community banks. Well, then what do you expect? Unintended consequences. All of a sudden you have this big flight of capital and liquidity out of these banks. They never intended for that. But it's because of that manipulation that they have these unintended consequences, and we're faced with what we're faced today. And then they've got to make another decision and another monetary policy to control it. So let's go back to my analogy of Yellowstone for a second. Remember I said that you've got dying, dead vegetation that builds up as fuel over time? Well, to some degree, banks experience the same thing when you have this influx of money. Now, remember back in 2020 during the pandemic, the federal government is printing trillions of dollars and pushing it into the system. Well, guess what happens? You create this abundance. And this abundance has to go somewhere. So where does it go? It goes into the banks. And what do the banks do with it? They've got to put it somewhere. The thing you got to remember about banks is that they answer to stockholders, just like you and me. And what do we want? We want a return on our asset. Well, if they don't do something with that money, well, guess what happens? The return on assets goes down, and all the analysts say, ooh, it's a weak bank, and the stock price goes down. So we basically are creating this abundance to them. They've got to place the money somewhere. So what happened in 2020? Let's take Silicon Valley Bank. They've got all this liquidity. They have to push it back out to earn money on it. So it's low yield, long term, and everything's fine if the Fed keeps its rates the way it is. The unfortunate thing that they didn't anticipate was a ratcheting up of the Fed fund rates, and frankly, it was the fastest pace I think ever recorded of incremental increases in Fed fund rates, and it caught them totally by surprise. So to a big degree, the Feds have a lot of skin in this game for what's happening with the bank issues right now. If you could imagine this, we're going along at 100 miles an hour. They've pumped money into the system. They've kept rates low. We're going really fast, and all of a sudden, they slam on their brakes, and just like a contagion, they're slamming into one another, coming to a dead halt. I mean, deal flow comes to a grinding halt. So in my opinion, the Feds have actively participated in the issues that we're facing today with the banks. Although they knew that these rate hikes were coming, no one knew the velocity of these rate hikes, and it frankly caught everybody flat-footed with how to balance their portfolios with their depository accounts and their loan portfolios. I'm not proposing that the Feds have still got any grand agenda, but as I stated previously, most everybody in the industry knows the Feds would rather have fewer banks than the amount of banks they had before. Actually, if you look back, there's been 18,000 bank failures since the Civil War. So this is nothing new. It's just a natural attrition. And as the chart shows, since the turn of the century in 2000, there were over 40,000 banks at that period of time. Today, there's 4,700 banks. That's how many banks have either merged or failed or been acquired. Now, a lot of that is due to the interstate banking laws that came about. But the fact is, the Feds are getting their way. We have fewer and fewer banks, and after this period of time, there's going to be fewer banks again. Money will go where it's treated the best. That goes with business, and that goes with depository accounts. You know, we're in the real estate development business, among other things, and we don't go into municipalities that treat our money bad. Frankly, we want to go where it's treated nice. Well, the same thing can be said right now with a lot of the cash and a lot of the liquidity that's coming out of the system. As you'll see by the attached chart, there's been $5.1 trillion flow out of the system into money market funds. I personally think that the herd mentality and the panic has subsided. People are seeing that the system is not going to implode, and the velocity of money has slowed down traveling out of the community banks into the bigger the banks, which is a good thing. The United States needs community banks. Did you know that over 70% of all commercial loans are originated by community banks? Not the big ones, not the J.P. Morgans, not the Cities or BOA, but the Anywhere Bank in America in Wichita, Kansas. Community banks are a vital component of the business process. To ag lenders, to small business owners, you name it. We need for the panic to settle down. We need for the money to stay where it is if possible. I'm not saying that you don't need to be prudent or educate yourself, but community banks need to stick around. And remember what happened with Silicon Valley Bank and Signature Bank and the other ones that were tied to crypto exchange. Those were outliers. They do not operate on the same business premise that the Anywhere Bank in America does, that we call our community banks, that are vital to our industries. You know, after all the brouhaha that came out after Secretary Yellen went on record saying that she was not going to backstop community banks, they did backtrack. And to their defense, they did create the Bank Term Funding Program as we described in the last video. This is a $28 billion backstop program. Now, if you think about it, there's $9 trillion worth of depository loans out there in the system, so it's really just a small minnow in an ocean of whales. But it is something, and as I talk to my banker friends, I've learned that really this is more of an optics issue to decrease this panic and herd mentality than anything else. But it is $28 billion that somebody could loan against their existing portfolio of bonds on. Since I have presented it, there has been a slowdown in the velocity of money that has gone out of the system. So now that we do have that panic subsided to some degree, there's still some burning in the forest that's going to happen. There will be more bank failures, but I don't think it'll be to the degree of the panic mode of some of the greatest eras that we've been through. Let's talk about what we might think will be the next big shoe to drop. That would be an industry that's totally in my wheelhouse. Fortunately or unfortunately, it's commercial real estate. Let me read to you what a couple of people said recently about what they feel is the alarming thing that's coming down the pike in 2023 and 24. First, this is from a gentleman named Marko Kolanovic from J.P. Morgan. That's a hard one to say. The guy advises investors to stay defensive and not be tempted to buy the dip in stocks, as he thinks the peak in equity prices has already been made for the year. The Market Insider article goes on to say, driving Kolonovic's bearish view, I did at that time, is a rise in risks associated with commercial real estate, which backs hundreds of billions of dollars of debt that is maturing over the next year that will need to be refinanced at higher interest rates. That could send shocks through the banking system, which has already been rocked by the collapse of Silicon Valley Bank earlier this month. Bill Ackerman from Pershing Capital, who we mentioned in our last video, says in this article, he underscores the key role that smaller lenders play in construction and real estate sectors. Actually, as I said, 70% of community banks provide commercial loans to commercial real estate. The billionaire investor and Pershing Square chief warned that if depositors pull their money out of those banks, that could hamper lending to those industries and cause a meaningful economic slowdown. So don't pull your money out of the community banks yet. We need them. Hear from Elon Musk. He says that he has sounded the alarm on mortgages and commercial real estate. The Tesla chief warned that banks could be hit by a surge in defaults and lower asset prices. Higher interest rates, depressed occupancy levels, and looming recession threaten loan portfolios. The turmoil in the banking sector could spread to the housing and commercial real estate markets. Musk goes on to say many borrowers could default on those loans in the face of sharply higher interest rates, depressed occupancy levels, tighter financing, and pressure on asset prices as recession fears grow. Around 70% of CRE debt in the U.S. is held by smaller banks, exposing them to major losses if those defaults occur. There's two more charts that I want to share with you that support this issue of this potential shoe that might be dropping in CRE. One is the tightening of lending standards in commercial real estate and multifamily as shown in Q1 in 2023, which is some of the highest tightening standards that you can see. But it's pretty common for these tightening standards, as you can see by the shaded bars, for these lending standards to be tightened prior to recessionary times. The other one is a chart that's put out by Longview Economics, which clearly shows the share of U.S. office space vacant in the 50 largest U.S. metro areas, which is now at close to 19%. And I might add that this is predominantly in two asset classes where you see the most trouble. One is a commercial office, which is softening, and the other is retail. On the other hand, multifamily and industrial, two asset classes that are still fairly strong and faring well. So if you're looking for the future of opportunity, keep your eye on these two specific asset classes. I don't think there's going to be a lot of deals to really be had in multifamily and industrial until the seller's expectations reach buyer's abilities. But I do think that if you look at office and retail, there's going to be some resets of rates that happen, which product is going to come on that you're going to have opportunity to look at. Somebody asked me recently, well, what are you doing? Well, personally, my pencil is down right now. I think that there's got to be a little more clarity on what's going on in the market. And again, as I said, sellers' expectations have got to meet the buyer's abilities. And right now, we're just not there. So in summary, let me give you an opinion and a little bit of advice. There's going to be more bank failures. It's just a normal cycle that we go through. The forest has got to burn just a little bit more for that good vegetation to grow out. Number 2, try not to be a part of the herd. 3, control what you can. Stay busy. Look for opportunities. Number 4, keep your powder dry, as always. And number 5, remember that opportunities always present themselves during these transitionary times. Be sure to like and subscribe if you enjoyed watching. Be kind to somebody today, and we'll see you next time.